Great. Let's move on and talk more now about security tokens. Let's start with the following question. So what's the big deal about security tokens? I mean, is it to fly under the radar of regulation, or is there innovation? And my question is, like, what are we solving, really? The securities markets work. So what's the big deal about security tokens? Do you want to start, Anthony?
I don't think there's a big deal, right? And so it's just a natural evolution of technology. If you think up until let's call it the 80s, we lived in an analog world with paper shares. We created new technology that allowed us to then put those paper shares electronically on the internet, E-Trade, TD Ameritrade, all stuff, trade them around, made it more efficient. And this is merely just a new piece of technology that allows us to continue to trade ownership and assets in a more efficient way. And so, I'm probably one of the most egregious at hyping this stuff, but I don't really think it's that big of a deal, and it's probably more of an evolution than a revolution.
Why? Let's continue.
Yeah, I think I'd agree with Anthony there that this seems like an evolution. It's a continuation of the digitization of these securities. But what tokenization gives us on top of just pure centralized digitization is really two things. One is access to a liquidity pool of people that have meaningful assets in crypto. It's much easier to move money from existing crypto assets into tokenized securities. And so access to that liquidity pool, being able to bootstrap liquidity for these new markets there is really powerful and something that you can't do today with centrally digitized securities. But even beyond that, and something we're seeing meaningfully every day, is that tokenization, as evidenced by all the people in this room, encourages action. It's an exciting concept. And there's a lot of securities out there that haven't had the force of will to become digitized and given an opportunity to build liquid markets online around the security. And the idea of tokenization is strong enough that it encourages people to actually take those assets, digitize them, give them access to initial liquidity pools, and then start to build markets around them. So even beyond pure centralized digitization, there are real advantages to tokenization. And like Anthony said, I think we're seeing an evolution there, giving this kind of the next step, the boost, making it so that all assets can be digitized and tokenized.
Stein, you're a bit of a contrarian there. Am I correct?
Yeah, I don't know if contrarian is the right term, but we do spend a lot of time thinking about really what problem are we solving, right? Are the security markets broken? Are we not able to issue equity in traditional form? Is a token that much different from traditional electronic book entry for what we have now? Are we unable to tokenize cap tables as it is? And so we kind of struggled with this a little bit as to, it's an interesting new tool in kind of the liquidity toolbox and the corporate finance toolbox, and there's kind of tremendous value in that. But as actually a new form of financing substrate without sort of clear liquidity and even a clear investor pool at this point, it's, as we talk to clients, it's a serious conversation we're having.
Josh, what do you think?
So I think we're conflating two different things. Inherent in your question is, well, don't the securities market work well today? And when you say that, we think the public securities markets. And the liquidity is great there. No one ever raised private capital and said, let's do it for the liquidity. But that's the whole promise of tokenization. We take the liquidity in the public markets and we bring a large portion of it down to private assets. Private placements today exceed public raises. And the reason why is raising money privately is faster, cheaper, and easier. You don't have the regulatory brain damage, you don't have all the expense, but the problem is the liquidity is terrible, it's not there. Tokenization can bring that liquidity to private assets. You get the best of both worlds. And I think you want to go back to where the whole finance industry started, which is if you go maybe a mile, I think that direction, it was a bunch of Dutchmen, a few Englishmen, and they were trading these little pieces of paper, and they were this newfangled thing called stock and a joint stock company, but it was two things. It was fractional ownership plus liquidity. In private placements, we have the fractional ownership. We don't have the liquidity. And once we do, we'll get the same transformation that we had 300 years ago at the corner of Broad and Wall.
Okay, we're going to come back to these use cases. So do you think that the current exchanges that we know of, the NASDAQs of the world, are the ones that will be embracing the security tokens? Or, as we are hearing now, there are new types of clearing houses and exchanges that say, well, we accept security tokens. So where do you think it's going to go, and how will they be traded, and why do we need new types of exchanges?
We need new types of exchanges because these are new assets, because you're going to get, as David was talking about earlier, you're going to get an explosion of assets and issuances. When you make raising private capital and trading it faster, cheaper, and easier by orders of magnitude, you get an explosion of use. Just like email to snail mail, you got an explosion of written communication. So when that happens, you're just going to need more venues. We think that exchanges are going to start to specialize by asset class and level of abstraction and security. If you're trading shares in a private REIT that are 25 grand a share, you have much different trading patterns and informational needs versus if you're trading, say, synthetic derivatives on top of that created by DYDX, that's going to look a lot different. You have different trading needs, you have different participants, you have different informational requirements. Some things are going to look like a Bloomberg terminal, some are going to look more like a real estate crowdfunding site, even on the primary trading.
Yeah, I'd add on to what Josh said there. I agree with all of that. But on top of that, there's a difference in the exchange world between traditional assets and tokenized assets that isn't discussed a lot. In the traditional public equities world, an asset and equity is usually only publicly listed on a single exchange. It may trade kind of under the covers on many of them, but it's publicly listed. Most of its volume goes through a single exchange. In the token world, what we've seen as the best practice is that tokens are listed on every exchange they can possibly be listed on that they feel comfortable with. And I think the same thing's going to happen in this tokenized securities world, where rather than being listed on a single exchange like the traditional world, we're going to see, for different reasons, these exchanges will specialize. Certain assets may want to be on one exchange because of their special liquidity pool that they have access to, another exchange because of a special type of trade that they allow, another exchange because of their specialization in a certain geography. And allowing for the diversification of where these assets are traded is really interesting. And one of the benefits of tokenization is that it actually allows for a liquidity pool across all of those exchanges to be built and an efficient price discovery across a number of different exchanges at the same time. It's a real difference from the traditional world and how these things are going to be traded.
So I'm going to take it a step further, and I think that what we're describing here is the medium term. The long term, though, is there's not going to be a difference between tokenized securities and not tokenized securities. I've gone as far as to say that I actually think the regulators are going to mandate that every single security digitizes, right? And the reason being, if you look at today, the SEC, if I do something that's non-compliant, they spend a lot of time, money, and resources to figure out that I did that. They build a case, and then they go ahead and they enforce on me. There's millions of dollars spent, usually about a 2-year process to do that. Well, as soon as we start to digitize these capital stacks for all assets, what happens is you take the regulation from being reactive to being proactive, right? So these guys are all building things that would basically prevent me through the protocol from actually doing that non-compliant trade. And so if you go to the regulators and you say, hey, I'm gonna save you all your time, money, and resources from having to be reactive, and I can put you in a position to be proactive, they're going to say every single person has to do this, right? And so I don't think that's going to happen in 3, 4, 5 years, but at some point in the future, there's not going to be a difference between the securities. Everything is going to become digitized. We're going to get away from that paper system, right? And so I think that that's just a kind of a further point of what these guys are talking about.
So in terms of the types of securities, the ones I have on my list are, some of them could be asset-backed, right? Some could be cash flow driven. Some could be just startup equity, plain private equity that now becomes more liquid. And then some could be earning dividends and giving back some portion. Are you seeing, is this the right kind of type of classification? What are you seeing there in terms of examples? And where might we see initial demand coming from in terms of the specific applications?
So I think some of the demand we're seeing when we engage with buyers and investors is kind of around more esoteric structures, like revenue streams, like yield-focused tokens, and even sort of emerging dual token structures where you have a funding token and then a functional token, let's call it a utility token, that then exists in the company's programmatic ecosystem. So I think this kind of innovation is what's exciting about this space. I think tokenizing equity to some extent is a problem largely solved.
So the folks we're talking to, I'd say 75% of the inbound interest we're dealing with is real estate specifically. And I think that goes to the nature of both the demand and the needs. So when you tokenize, just like with email, you can more efficiently communicate with a larger number of people. When you tokenize, you can efficiently aggregate a larger number of investors. And so in real estate, these folks are used to dealing with the same 5, 10, 20 LPs every time. They want to get a more diversified investor base from around the world, and you can't efficiently do that in private placements unless you tokenize. I think what's really interesting for us in the crypto community is once you take a very stable asset like prime Class A real estate, what then can you do in the crypto economy? So if you think of MakerDAO and the search for a stable coin, if you, right now, you collateralize with crypto and you have to way over collateralize, 2x or 3x, and that currency peg will break the moment that people have a generalized loss of confidence in cryptocurrencies, even for a moment. But if instead you're collateralizing DAI with real estate, now suddenly you only have to overly collateralize, what, 10, 20%? You have a pegged stable coin you can believe in, and then think about how commerce and applications explode on the blockchain. Once you have a crypto token, that is something you can trust as equivalent to fiat. And so I think security tokens aren't just about securitizing or tokenizing real world assets and tokenizing current securities. That's a fantastic opportunity, but it also has knock-on effects that are very positive in the crypto economy.
Real estate's a really good example, I think, too, just to add on to what Josh said there, because of the cost associated with structuring real estate products. So what I mean by that is that REITs, a real estate investment trust, are actually a pretty simple concept at a high level. You want to invest in or short lower Manhattan real estate. And traditionally, these are built by financial institutions because they need to buy large chunks of a bunch of real estate in lower Manhattan, put it all together, and then allow investors to buy small shares in that aggregate product. And what ends up happening there is that the price of that product is more than the combined value of the assets it holds because they charge a structuring fee. The institution needs to make money. They're doing the work here. They have proprietary access to this real estate. And so they charge a fee on top of what the real estate costs. And so you're holding an asset that actually costs you more than the stuff that it contains. And one thing that's so interesting here is if we reach a world where all of these assets are tokenized and tradable on the markets, I can programmatically, for free, build a lower Manhattan REIT for myself. I can buy 1/1,000,000% of every building that's tokenized in lower Manhattan and effectively have that REIT product in my portfolio without ever charging a structuring fee, without ever paying a structuring fee to an institution on top. So a lot of the demand that we're seeing is for types of assets where there's a lot of structuring that goes into products that people end up buying on exchanges or from institutions at the end of the day, but where those products themselves are actually not that hard to create if you have access to the asset. The product isn't complicated, it's just getting the access that is, and that's a real benefit of tokenization here, that we can make these things more easily tradable and lower cost for consumers and investors to get involved with.
But real estate is a good example. I keep hearing about real estate examples for the blockchain and fractionalizing ownerships, and there are probably at least 10 companies that are working on some kind of technology platform for it. But I have not seen a real example yet. Who is really doing, who's putting REITs on the blockchain?
So there's a company called Brickblock that has a multifamily unit in, I think it's Germany, right? And they've actually tokenized the equity. I think that one key thing here is, so I keep going back to this idea of like, this isn't revolutionary, this is just evolutionary, right? So we tokenized an Inc. 500 company, whether you do it with a building, a company, whatever. All you're doing is you're doing a one-for-one swap of the paper share certificate for a digital token. You could technically go rewrite the charter of the company to one-for-one swap the paper share certificate for a rock and just say, hey, the equity in our company is represented by 10 rocks. If you hold one rock, you own 1/10 of the company, right? It's just a different unit of ownership. Now, that unit of ownership brings a whole host of things that obviously we're all excited about up here, but I think that is not a huge innovation, right? The underlying technology obviously is, because it can be managed by the blockchain, et cetera, and it opens up this new world. But I think that the idea of tokenizing is just simply swapping out that unit of ownership.
You think it's going to take off in the commercial sector prior to the retail, personal types of markets?
I think that initially a lot of the liquidity on these things will be bootstrapped by people that are retail crypto investors, but have made meaningful capital from crypto investments, as many people have in the past 6 or so years. And so I think that's a real way to bootstrap it, because right now, as we're all talking about, a lot of the infrastructure is not there for traditional capital to get into this tokenized world, especially tokenized securities. That is being built as we speak by a lot of people, but it's not quite there yet. So I think a lot of the initial liquidity will be from crypto wealthy folks that want to diversify their portfolios into non-correlated assets separate from the pure utility token or functional token world. But at the end of the day, the liquidity comes from institutions, and the industry needs to build technology and infrastructure to support institutional investment in these if we're going to build real efficient markets for each of these products.
I'd add one other source, and that is overseas investors, particularly those in unstable countries. So the whole promise of Bitcoin, going back to the original white paper, was that you had a store of value that you could rely on. Real estate is that non-volatile store of value. And I was listening to a podcast the other day. Professional class in Brazil, lawyers and doctors are putting 10 to 20% of their net worth into Bitcoin because they're looking for that stable store of value outside. If they're going to put it into Bitcoin, they're going to put it into U.S. real estate. And I think when you think of people buying apartment buildings or apartments, condos that sit empty just because they're looking for a place to park their money, you can now put it in a yielding asset that's diversified and that you have liquidity on. And I've heard sometimes people say, well, it's just liquidity. I mean, 20 to 30% of the value of an asset is not just liquidity. That's meaningful.
I think going off of that too is in the utility token space. I think the big question that a lot of like traditional investors and institutions have is, what's the inherent value, right? Or all the knocks against those utility tokens, the security tokens answer, right? So what's the inherent value? Well, there's an underlying asset, right? Why would somebody want to do this? Well, we already see the international investors trying to get their capital into the U.S.-based assets, right, in terms of real estate, et cetera. And so all that's happening here is this technology is just breaking down some of the friction for what people are already trying to do. And so I think that's, it's a clearer path, I think, to building sustainable value than some of the utility token stuff, and we'll see what happens on that side as well.
Yeah, I think I like the comment that we're just so early in this space that, quite frankly, the blockchain-y part of it just needs to be abstracted. Traditional investors are conservative by nature, and so private keys to along those lines need to just be made simpler, more efficient. The other piece of this is how we think about the buyer and the investor universe, right? And I think we all know that the traditional fiduciaries are not in our space yet. We have lots of sort of adventurous family offices that are looking at this stuff and saying, okay, this is interesting. But then the kind of the thought leaders in the broader blockchain space are mostly focused on core protocols, dApps, dApp infrastructure. And so this is a little bit outside of their thesis. And so I think we're kind of a bunch of supply looking for demand at this point because we're so early. And as the infrastructure gets better, as the quality of assets we're offering is better, as liquidity pools appear, liquidity protocols appear to make the pools interchangeable, I think that's when we're going to see a real push into this asset class.
I think this is an important point, which is it doesn't happen overnight. It happens incrementally over time. And as these come out more and more, the reaction, I think, the wrong reaction is, oh my God, it's not the New York Stock Exchange on day two. This happens over time. And each time there's an additional issuance, it draws in more investors. Each time there's more investors, it draws additional assets. And you get a positive feedback loop. It's going to happen quickly, but it's not going to happen overnight.
Andy, go ahead.
Yeah, I'll add one more comment. You brought up NASDAQ and ICE and other traditional players are looking at this space. I think it's reasonable to conclude that they're pretty aggressive about this. And we talk about, now in this space, we're talking about issuance. How do we issue, Reg T, 506, et cetera. And in 12 months, we're going to be able to trade these things, right? And so the behind the trade infrastructure and the regs really haven't changed. You still need a clearing broker, still need a transfer agent. And they have a structural advantage in that, A, they get to participate in the writing of those regs, and B, they have the infrastructure. And so to some extent, it's a race for all of us against their traditional market infrastructure, because certainly they're really focused in the space and they have very deep resources.
Good. Andy, you ran a free session yesterday, I think, where we invited startups to come in and you gave them free legal advice if they wanted to do security tokens. Is that correct?
Yeah, so Coinlist yesterday hosted we called it legal office hours. We got about 10 lawyers from 8 firms to come and volunteer their time to consult with token projects about what they're doing and give them some high-level guidance and talk about some of the issues that they might face.
So what did you see? What can you tell us?
Yeah, so interestingly, and this goes back to Anthony's point earlier, for ones that are conducting securities tokens offerings, I actually think most of the regulation and legal questions are relatively clear because this feels like an evolution of existing digitization of securities. There aren't a ton of open questions in the securities token space about regulation. There are certainly some as we talk about things like decentralized exchanges, where burdens of things like know your customer and anti-money laundering and other transaction requirements are checked, and a few others. But really, most of the questions we were seeing from these issuers were around utility tokens, which is much more untouched soil with regard to regulation, and a lot more questions about SEC, IRS, FinCEN, CFTC, all these different agencies and how they're going to play in the space. But for the securities tokens projects, I actually think most of their questions were much more practical about what are the next steps and less about these high-level regulatory questions that are really plaguing the utility token space separately.
So based on that, do you see that there's going to be more activity this week, this year, about like more? Are we seeing more? Is this the year of security tokens?
Yeah, I think there's absolutely going to be more activity this year around securities tokens. We've seen lots of folks approach us about tokenizing different assets or building different two-token models, which is another one I really do like, a funding token and a functional token separated out in a token model, to Stan's earlier point. But I also think things like Morgan Creek Capital is a really interesting case because announcing a big fund is a way to incentivize good assets to move into this space. It's a virtuous cycle. As liquidity comes into the space, as capital comes into the space, more and more high-quality assets will be willing to tokenize and offer their underlying asset on the chain. So I do think that that will go back and forth, and as more assets come on, more firms will come out. So yeah, absolutely. Rest of this year, next year, we see a real boom in these things coming from all sorts of different assets.
I can tell you that in the conversations that we have with folks both on the institutional side, LP side, et cetera, as we talk about this, the number one indicator I see is the conversation somehow always ends up, I have X asset, how do I tokenize it? Right? And so it literally can start off with, I don't understand anything about this, I don't, whatever, but it always goes back to, I have an asset, this seems like it's valuable, how do I do it? Right? And so I don't know how long that takes, but these are incredibly smart people, usually fairly wealthy, right, have done well for themselves. And if they're able to get to that point in usually a first or second conversation, you've got to imagine, 12, 18 months from now, we're going to see kind of that flood, I think, that we're all anticipating at some point.
So how will you make your investment decisions? Because you said that you are going to be focused on security tokens and so
yeah, I mean, look,
here's
the big secret. We're going to go buy up every asset we possibly can because every asset's going to be tokenized. And while everyone else is asleep at the wheel and doesn't understand how this works, there's a huge opportunity, right? So think of it this way. Any asset that I would be happy to own in the private illiquid market, I'm going to be more than happy to own in this market. So it's just classic investing. There's nothing new about this. We just think that there's a window of opportunity where as these assets are getting tokenized, there's some premium that puts on the valuation, but there's just very little competition, right? How many other funds out there are looking to invest in this stuff? I don't know. There's some, right? But there's just not as many as, let's say, a traditional real estate fund, a REIT, et cetera.
But will you invest in companies that are the ones that are putting those assets on the blockchain, or will you invest directly into the assets?
We'll do both.
We'll do both, okay. So how about, let's talk about regulation for a little bit. What do you think regulators what will be their actions potentially this year in terms of security tokens? The proverbial debate now is it a utility or is it a security? And everything seems to be framed around that conversation. And we're going to talk about that multiple times today. But I thought I would allow each panel to take a shot at it.
So I'll start by saying that everything in the U.S. now exists in a private placement regime, right? So when you're talking about tokens, it's not only what you're selling, but how you're selling it. And how you're selling is a private placement now, regardless of what, in the end of the initial security, whether you deliver a security or deliver a commodity or a product or a good of some sort, right? So I think that argument is settled as to how you sell things. I think the argument around what's at the end of it is a token that has programmatic value and is functional in a technical ecosystem, or whether it's a claim to some sort of rights or representation of a cap table or a stream of cash flow. How that's treated is actually still an open question in some ways.
Yeah, I do think it varies asset to asset. But one example that we see is if you look at, and this is I think an underrated development in this space, if you look at the Delaware corporate charter, they've actually amended it to allow for tokens to represent shares in a company. So tokenization of Delaware companies is actually really easy now. Instead of using a paper stock certificate or a digital stock certificate like you might use on eShares or Carta, you can use a token to represent that ownership. And that's very straightforward at that point, how that's treated from a regulatory perspective. It's the exact same as a digital ledger that's centralized or a paper stock certificate. And so there's straightforward cases like that. I do think for some of these, as you look towards the dual token model, as you look towards interesting cash flow tokens, that's where a lot of the regulation becomes more uncertain. But at the end of the day, most securities tokens are based on some underlying asset. We know how to regulate those underlying assets, and the regulation of the token on top will really not be fundamentally different from that asset regulation.
Okay. We're going to change things a little bit this time. If we have time, we're going to take 1 or 2 questions from the audience. I'm not sure if David is here. We have runners. Let's take 1 question from the audience. Does anybody have a burning question about security tokens they would like to ask?
Ladies and gentlemen, if you could kindly raise your hand and wait
Just
for a
1
microphone
question,
to come
and
to
then
you.
we'll end the panel.
Here you go.
Over there. Okay, here. Go for it.
Thank you. My name is Ladislav. Thank you, William. One question that I would have for you guys is, what platform would you tokenize these tokens on? Public blockchain, permission blockchain?
Yeah, so we're focused on Ethereum, ERC20 standard. We believe the public blockchains are important, the non-permission ones, because it engenders confidence worldwide, because you can plug into an entire ecosystem. You have the 0x protocol. You have a number of centralized and decentralized exchanges springing up. Some of them I think are really interesting models in the centralized part where they essentially run a side chain batch of transactions and then settle on the main chain, which gives you a little bit of the best of both worlds. There are folks like Templum doing interesting things, or Open Finance. You have qualified custodians, you have traders like Gemini or DRW. There's a whole ecosystem. And I think when you do a private permission blockchain, you don't have an ecosystem. You have to do it all yourself. That didn't work in the internet era, and it's not going to work in the blockchain era.
Any other questions?
I'll answer that by saying that one of the wonderful things about the token market to date is that it's been, I think, probably the first pan-jurisdictional market. And so maintaining that liquidity and global access to it at a protocol level, I think is very important. So creating a tool set that's compliant, not only in the US in respect of issuance and trading, but globally, and having that basically set of rules programmatically embedded in tokens that are securities would kind of be amazing. So I think bringing that pan-jurisdictional global liquidity to securities, I think is a very important mission.
Great. Let's move on to the next panel. Thank you very much.